welcome to our Financial Strategies and Opportunities for Singapore Residents in 2023 event, brought to you by LINC Wealth Advisers, leading financial advisors for residents of Singapore, including expatriates, and a branch of Synergy Financial Advisors. You can find out more at linkwealthadvisors.com. I'm delighted to be joined by Raina Akbari, Gary Brown, and Joe Onkeko from LINC Wealth Advisers. Originally from San Francisco, California, Raina lived in Germany for 13 years before moving to Singapore in 2005. After a career in corporate banking, he moved into private wealth and risk management and launched LINC Wealth Advisers in 2020. Gary is originally from Wales in the UK. He has decades of experience in financial services, including many years at Barclays Bank. He specializes in retirement planning across the expat space, offering a holistic approach to financial planning. Gary moved to Singapore 10 years ago. Joanna moved from the Philippines to Singapore over 14 years ago. She previously worked at Prudential before joining LINC. Before we start, please bear in mind that the information presented is for general educational purposes only, and you should always seek your own personalized financial advice. After the presentation, Raina, Gary, and Joe will be answering your questions, so please add them in the Q&A pop-up at the foot of your screen, as and when you think of them, and we'll try to answer them all, time permitting. So, without further ado, I'm going to hand over to Gary.
Just to briefly run through the agenda, I'm going to talk about financial strategies, dollar cost averaging, and compound interest. Then I'm going to pass you over to Raina Akbari, who will discuss going from anxiety to investing with confidence, and then on to Joanne, who will discuss essential insurance, critical illness, and health coverage. And at the end, we'll have a Q&A session. If I could have the next slide, please. Okay, so I'm going to discuss a couple of concepts in relation to investing. First one is known as dollar cost averaging. Now, I've got the definition from Wikipedia, which states that dollar cost averaging is investing the same number of dollars or currency each month to acquire more shares when the market is low than when it is high. So on average, if you invest on a regular monthly basis, you will find that on average, your return will be higher than investing in one lump sum. So can I have the next slide, please? Next slide. Thank you. So I just got a couple of definitions here to briefly mention. So dollar cost averaging is when an investor allocates a set amount of money at regular intervals. So you're investing on a regular basis. Dollar cost averaging is generally used for more volatile instruments, financial instruments such as stocks, mutual funds, rather than for bonds or certificates of deposit, for example. In a broader sense, dollar cost averaging can include automatic deductions from your salary or paycheck that can go into a retirement or savings plan. So dollar cost averaging is a good strategy for investors with lower risk tolerance. If you have a lump sum of money to invest and you put it into the market all at once, then you run the risk of buying at a peak, which can be unsettling if prices fall. The potential for this price drop is called a timing risk. That lump sum can then be put into the market in small amounts over time, with dollar cost averaging lowering the risk and effects of any single market move. So the concept is basically quite simple. Rather than invest in a lump sum at one particular time, when the market may be at a high, you invest on a monthly basis. So when you've got highs and lows during the period, you will find on average that you will get a higher return. Next slide, please. So here I put a brief example showing the effect of a lump sum investment of $800, and then the effect of investing $100 each month as the market fluctuates. You can see on the top example, you would get a zero return, but on the bottom, by using dollar cost averaging, as the market peaks and troughs, you will get an average unit cost of $8.16 and a 20% return for your funds, as opposed to zero if you put a lump sum in. Next slide, please. Okay, so dollar cost averaging. Again, just to reiterate, as markets fluctuate, by investing on a monthly basis over a period of time, the averaging of the fund prices will show a better return. So say you invest $1,000 a month every month, as opposed to investing $12,000 in one lump sum, you will get a better return by investing monthly. Because as prices rise up and down, on average, your return will be better over time. Next slide, please. And again, this is just reiterating what I said earlier. We're giving you some examples. You can see the return in this example. If you put a lump sum investment of 8,000 in, 0 return because of the market's volatility, basically. And in the bottom, you can see that if you invest 1,000 on a monthly basis, you are going to get a positive return. So this is a simple example of illustrating the benefits of dollar cost averaging. Next slide, please. Okay, so I've talked about dollar cost averaging, the concept of dollar cost averaging. And I want to talk about something which I'm sure you're all familiar with, compound interest and the power of compound interest. Why should investors be concerned with compound interest? Compound interest demonstrates the growth of money over the long term. The concept is similar for long-term investing. If you consistently invest over the long term, your portfolio will begin to grow as both capital and past profits grow. Next slide, please. So I put this in a simple example. Should you invest $500 a year at an interest rate of 10%, and should you leave that money in your portfolio or a bank account, for example, it shows the benefits of leaving the money in. You're basically getting interest on interest. So if you invest $500 in year 1 at 10%, you get $50. Year 2 interest, another 10%, so $550, you get $55. And as you can see, year 3, year 4, and year 5, the benefit of compound interest is your £500 will grow to $805 over a 5-year term. But should you take out your $500 every year, you're not going to benefit from the interest which is accruing. Next slide, please. Okay, so this is another simple graph, the magic, as we say, of compound interest. You've got your original growth over a 20-year term, and the effects of leaving your interest or any dividends, for example, in a portfolio. Your growth, as you can see by the blue line, will be substantially more than if you were to take your money out on an annual basis. So that's the power of compound interest. Next slide, please. Okay, I'm now going to hand you over to Raina Akbari, who will go through his presentation on going from anxiety investing to investing with confidence. Thank you.
All right. Thank you, Gary. Next slide, please. So as a wealth manager, my job gets particularly exciting and challenging when markets experience turbulence and severe downward corrections, as was the case last year. When investors see red and the news is all bad, they reach out to their financial advisors in a heightened state of anxiety, wanting to take some evasive action. There's a strong human nature to do something, to be proactive. You want to solve the problem. So I'll often hear from clients things along the, something along the lines of the following: let's sell everything and wait to see what happens. Or let's sell everything and buy in at the bottom when prices are low. Or let's shift the portfolio into something else that will gain back what we lost. Next slide, please. But what happens when market sentiment is positive or downright exuberant? Is my job really that much easier? You would think it is. Well, clients tell me the following: shares have been climbing a lot, but my portfolio has not performed well at all. I need to grow my wealth, so I'd rather take a lot of risk to make this happen quickly. My friend made 20% on his return on his investments in technology in just a few weeks. I want to switch everything into technology shares. Or technology is the future and will always be good. So why are we buying more? So really, no matter what the state of the market is, there will always be anxiety among market participants. Thank you, yeah. So a client advisor's role is to manage client anxiety associated with investing and to guide and educate the investor to grow his or her wealth over the long term, following a consistent strategy and plan. Next slide, please. So how do we invest with confidence? Next slide. So the first point that I wanted to mention is avoid being swayed by feelings and emotions. This is, of course, difficult to do for most of us as human beings. And often our idea of what is a good return is based more on perception than on reality-based facts. So when somebody says, oh, I made tons of money investing in the Hong Kong or the Hang Seng Index, it's the place to invest this year. Well, that's pretty easy to check. You can refer to charts such as this one, or charts and tables to gauge whether that's actually translating to real stock market returns relative to other geographies. And if you look here, the Hang Seng Index was down 11.85%. So benchmarking against what a friend said their investment returned is usually not a good idea. Firstly, it's human nature to talk up one's successes and downplay losses. Also, the level of risk tolerance of a friend's portfolio may not really be suitable for you. Next slide, please. So the other point is to focus on the facts. I like to draw on facts as in the previous table, yet I see people compare their portfolios to a thin sliver of the market like the S&P. So if someone is invested in a globally diversified portfolio, globally diversified portfolio that consists of equities and bonds, it doesn't make a lot of sense to compare to the S&P, which is a US dollar denominated equity index. So when we get the facts wrong, we get anxious. And it's important to get the facts right to reduce anxiety and invest with confidence. So determining one's risk tolerance. Now, this is a big one for me, and it's come up a lot of times in my work with clients. Before investing, it's important to do a risk tolerance assessment. And let me just see for a minute. So I guess, so it's important to do a risk tolerance assessment, which involves answering a series of questions. For example, if the markets drop by a certain amount, what would your reaction be? So let's say the market drops by 10 or 20 or 30%. Would you want to buy more shares, or would you panic and want to sell everything? Now, oftentimes this step really gets brushed aside more as a form-filling exercise. So, but getting it right is really one of the most important aspects of investing with confidence. And I'll give you an example. So let's say you have a client who has just retired, but he's still keen to invest into an aggressive portfolio because he's heard a million times that the markets always recover. Well, he's certainly not wrong. The markets will eventually recover. But in this case, he's taking on a lot of unnecessary risk because he might have to start selling part of his portfolio and realizing losses to pay for his living expenses. In retirement, it is more important to protect assets and reduce one's portfolio risk. So really developing an awareness of one's risk tolerance and managing any future changes is one of the keys to investing with confidence. Next slide. Yeah, that's the one. Thank you. So avoid recency bias and other flashing lights. History has shown that no one industry outshines all the others over the long term. This may sound really strange to some of you because we have witnessed a huge run in technology shares over the past many years. But a look at stock market history shows this wasn't always the case. The illustration that I've put here, it illustrates basically the unpredictability of the markets in general. You can see that information technology didn't even exist as a sector until the late 1900s, and performance among the sectors has been pretty much random. So in the late to mid 1800s, transportation was the growth market of the day, yet look where it is today. So it's that little tiny dark blue sliver at the end. Next slide, please. So when investing with confidence, you can just simply let the market reward you. Just as in any industry, asset management companies will market their products and services to investors in such a way as to grab their attention from so many other distractions by convincing them that they have the special sauce to outperform the market, or that investment guru who's ranked in the top percentile of the year prior. Yet research based on actual market data has shown that predicting the future is anyone's guess. Now, don't get me wrong, even I like to take a view on stocks and bonds and currencies, real estate, all these investments. But however, this is not really dissimilar from investing in the lottery. And do we really want to plan, do I really want to plan my survival in retirement on a series of gambles and wizardry predictions about the future? So the closest an investor will get to a guaranteed return is the long-term market return. So why is this the case, and why am I so certain? Capital markets function on the basis that a provider of capital will earn a profit on their investment to compensate for the risk taken. Based on more than 100 years of stock market data, we know this lies between 8 to 10%, which is well above the risk-free rate, and also above the rate at which, or that's the risk-free rate is the government borrowing rate. So the proof is in the numbers. As you can see here, what I've written down, the MSCI World Index has returned about 10% on an annualized basis since 1970. And this time period includes lots of problems that we've seen. For example, the Iraq War, the Asian financial crisis, the GFC, 9/11 terrorist attacks, and even COVID, and so many other more challenges. So all you had to really do was just to remain invested in the market to achieve the 8 to 10% return. So my final point on how to invest with confidence is to focus on what you can control. Investing in the markets involves volatility or changes in price. This happens all day long when markets are trading. So if you're monitoring your investments on a frequent basis, you become anxious, or you risk becoming anxious. Markets are by their very nature volatile, although the degree can of course vary over time. So to reduce anxiety, it's important to focus on the plan and the goal to be reached, and other aspects in your control, such as the monthly investing that Gary talked about. This long-term view will help you keep focusing on, or help keep you from focusing on the day-to-day price swings, which are part and parcel of investing. So thank you very much for your time today, and I will hand over to Joanne.
Thank you, Rainer. So for my side, I'll be discussing the essential insurance. Just trivia that we got from sbr.com.sg. An interesting fact is only 15% of Singapore residents have adequate critical illness coverage. So that means that a lot of us, or at least 85%, are underinsured, or probably doesn't even have critical illness coverage. Next slide. And why do we need critical illness coverage? So I'm sure a lot of people know already, but for those who might need a little bit of hand-holding on the definition on this, it actually provides a lump sum of money to cover your medical expenses, regardless of which country you are in. So it removes the burden of using the family savings or even your emergency funds. So, and it also serves as an income replacement. So when someone is critically ill, you can use the lump sum of money for daily living expenses. And of course, the good part is that you can just take the time, take as long as you want to recover and focus on getting well. Next slide. Okay, some data from last year, 2022 critical illness data. 1 in every 4 to 5 Singaporeans may get a critical illness for any stage. There, of course, the early stage, the intermediate, and the last stage. as of the top cause of death in Singapore, cancer is the top cause of death last year as 28.4%, and also 39.67 cause of death claims. And as for the claims for all the life insurances, insurance companies, critical illness also tops it at 49.68% of claims. And an average information, most critical illness claims happen from age 51 to 55. Next slide. Okay, some type of insurances that you can use to cover critical illness is, first one is the original one, I would say, which is the term critical illness. So for an amount of money, a premium, you can get a lump sum of sum assured that will be paid upon diagnosis of critical illness. But in the event that you don't claim anything and it basically runs its course, there's no cash value to it. Then the second one is a multiple critical illness claim, which is somewhat of a hybrid from the first one. So it's also a term critical illness, but it can pay you more than once of claim of sum assured, however or how much you bought. Let's see if it's at 200,000 or $500,000. And then the third one is the critical illness in whole life insurance. So whole life insurance is actually also covering death and disability, total permanent disability. And critical illness is just one of the factors that you can add in, or optional riders. But for this one, the main difference is that it is whole life. It can cover you whole life. And also there is a cash value to it. And also another thing that might be interesting, it's also a one-time claim as well. Next slide. Okay, now let's get into some important question, like how much critical illness do we really need? So as we have read from the very first quote that I opened up earlier, we are basically underinsured, at least 15%, 85% of us. So according to LIA, or Life Insurance Association, the average cost of treating a critical illness can be between 100,000 to 200,000 per year. So bear in mind, this is an average information, average data that they have, but of course, it also depends on the lifestyle of a person and the monthly expenses of a person. So experts also recommend covering minimum of 5 years of living expenses. So this is roughly the time that the average person needs to recuperate from critical illness and then go back to work and also adjust the lifestyle. So for example, someone or a person monthly expenses is 10,000 per month. So that's 120,000 per year. So we times it to 5 years. This is very easy math. Then technically, the ideal coverage that he should take, or she should take, is 600,000 coverage of critical illness or sum assured. Next slide. Okay, now let's get into some basic information on private health insurance that are available in Singapore. Health insurance, this one is a little bit different from critical illness. We're mainly talking about hospital plans or medical coverage. There is, of course, for the Singaporeans and the PRs, MediShield Life. There's corporate plans. Corporate plans would be pertaining to those that are covered or given by your companies. And then a private international plan, or also a private shield plan. So next slide. Okay, so a few questions actually on health or hospital insurance considerations for those of us that are in Singapore. One is your policy lifetime renewable? For this one, it depends on what kind of hospital or health insurance you have, whether it's an international health plan, or whether it's a shield plan, or whether it's a corporate hospital group insurance. So it's always different, but for most of them, if you're a Singaporean or PR for shield plan, it should be lifetime. But if you are on EP or SPAS, and that basically cuts it to maybe 70 or 75 years old. But again, it depends on the provider. So you will have to check because there are tweaks here and there. Second is, are there any limitation to the providers that you can use? So these are the things you need to check. And what are the reimbursement limits? So different strokes for different folks, basically. There's a lot of health and hospital insurance companies. And then you just have to really check what is the maximum that you're buying. Or you can choose between the ones that they have. Most of them would be around 1.5. For international health plans, it might be higher. Actually, it might be even 6 million or up, but it basically depends on the factors like budget and what coverage. Do you want the coverage to be only in Singapore, or do you want the coverage to be globally since you're traveling a lot? And then what are the exclusions? The exclusions would be pertaining to whether you will be given an exclusion based on the current health status that you have right now. So you will have to declare everything. If there's nothing, then you're on standard health or standard status, which basically means most likely you won't get any exclusions. But of course, if there's already some pre-existing health conditions like diabetes, hypertension, we will all have to declare that. And then an underwriter would be assessing that. If there would be exclusion, or maybe there will be some loading. That's also possible. And does it include like maternity, dental, outpatient, preventative, alternative treatments? And will your policy cover your family? So these are maternity, dental, all these questions are actually more for international health plans. These are maternity, dental. Usually you can add it on if you want to take. If you want to take it, it's better to take an international health plan because they allow you to do that. For local shield plans or hospital plans in Singapore, they're a little bit limited when it comes to this part. And lastly, does it provide cover for pre-existing or chronic conditions? So again, it depends on the provider, the health insurance company that you are looking at, because some of them allows, but you will have to pay something extra like a loading. But some of them won't really allow you. So that means it's already exclusion. But again, with the exclusions, based on experience as well, you could always appeal after a few years if you already got cleared of these conditions. Let's say in 2 to 3, 5 years, you can get a doctor letter, and there is a way to appeal for this. But of course, it's always based on whether they will accept it or not. So we can always try to remove any exclusion, just so that you know. And next slide, please. I think that's almost it.
And thank you all very much for those excellent presentations. Got a couple of questions coming in and a few more that were sent in beforehand. So we'll jump straight into the Q&A. I can actually answer the first question that's been asked today. Will there be a replay of this event? And the answer is yes, there will. It'll be up on YouTube and available on linkwealthadvisers.com and probably tomorrow. So check back into linkwealthadvisers.com if you'd like to rewatch the event at a later time. So first, a question from Jasmine. May I ask which are your partner insurance companies in Singapore?
I'll take that one. Justin, we have a lot of insurance companies, so it really depends on what your needs are. We would meet with you and assess the requirements, and then potentially compare against different partners and so forth. So it really depends. We have lots of companies that we work with.
I suppose that's ideal, isn't it? That allows you to sort of scan the whole market for best option for each client. So that's reassuring. Here are some questions that were sent in earlier. Let's start one for you, Gary, about dollar cost averaging. So the question is, if you're saving on a shorter time scale, say just a few years, perhaps you're saving for retirement and you have some money available to invest a few years beforehand, does it still make sense with a short time scale to do dollar cost averaging?
Yes, it does, because you're going to time the market peaks up and down, and over a period of time, you will find that the average return will be higher. Going back to the previous question, we search the market for the best solutions. So we're independent, so we look for the best solutions from a number of providers. And some providers, for example, on the dollar cost averaging product, which is normally called a regular savings plan, can start from 5 years upwards. But we normally try to define clients' goals. So for example, if they want to retire in 20, 25 years time, we would recommend we set up a plan for that period. Should they want the funds for maybe a holiday or education for their children, we would time or make the timeline 5, 10 years, depending on the requirements. So going back to the question, yes, it does make sense to dollar cost average, because rather than put a lump sum into an investment on, say, day one, when the market might be at a high, by putting it in strategic amounts over a period, you are timing the market and you're picking up the troughs and the highs, but on average, you will get a better return. Thank you.
Thank you. That's great. Just another question from Jasmine, which again is one I can answer, which is just to repeat the contact info from the last slide. And the email address is contact@lincwealthadvisers.com. And you can find that anyway on the website, LINC, LINC Wealth Advisors, advisorsers.com. So moving into another question that was sent in earlier. And Raina, this might be one for you. Where in the world do you recommend investing for residents in Singapore this year?
Okay, well, my approach is really for a really well-diversified portfolio. So I would not look to, honing it down to one particular geography. So let's say Europe, or, I wouldn't be saying that something is undervalued necessarily in my mind. That's basically the way I'm thinking nowadays. So I would rather be looking to buy the market as such, something like an MSCI World Index or something that gets close to that, which is going to be well diversified across many different currencies and many different industries and geographies. So that would be my, what I would be looking at. Of course, if the portfolio is very large and, you're talking about a high net worth investor, then obviously you might get into some other strategies. But generally, I would say for month-to-month savings or, your average person's portfolio, I would be looking to really try to buy the market rather than pick and choose what you think is going to outperform everything else. Generally, we see that strategy doesn't work. You might get it right a couple of times, but you'll get it wrong many more times. And for example, if you look at the returns of the country returns of the countries worldwide, you'll see that the best performing market was like something like Finland, which nobody would have known that. Nobody invested in Finland because they thought that would be the best place to invest.
Thank you. Here's another question about investing in general. I suppose two themes that we read a lot about at the moment are inflation and a strong dollar. And how are these affecting investing for investors in Singapore?
I'm quite happy to. Sorry, go on, Raina. Well, I'm quite happy to take this. I mean, inflation is rising rapidly in most countries now. So the secret is really to find some inflation-proof investments, which is difficult. So as we said earlier, the benefits of the main remit for investing is to spread the risk. So don't put all your eggs in one basket. So you'll find that if we look at different asset classes, you might get better returns for, say, global equities or precious metals. So if we diversify, we try to ride out any inflation problems. As far as the dollar is concerned, most mutual funds nowadays are based in dollars, and the Fed in the US basically dictate interest rates. So the dollar is quite strong at the moment. So we would look to maybe put a lot of our monies into mutual funds in, say, the US. But basically, it's all about spreading the risk and investing in different asset classes. So that's the main reasons.
Thank you. A couple of insurance-related questions as well. So the first is, would you recommend getting both critical illness and health insurance cover, or do they overlap?
Sorry, can you repeat that again?
Yes, would you recommend for somebody to get both critical illness and health insurance cover, or do they sort of cover the same thing, so you wouldn't need both?
Actually, it's ideal that you have both, because hospital or a hospital coverage would mainly talk about, or would mainly cover you for any hospitalization, even the most minor one, like someone got a concussion or something, to the major one, which would require surgery. And this will be mostly reimbursed for Singaporean PR, or even for work pass holders in Singapore. However, the critical illness is a lump sum of money. So when someone is not even in Singapore, they can take this lump sum of money and have treatments somewhere else, which basically gives them more option to choose if they want to choose the doctor or the hospital. And also the critical illness coverage is also access income replacement, which we discussed earlier. So if someone is sick, or like with critical illness that is quite severe, they can take time off work, and then for the next 2 to 3 years, since they have this lump sum of money, their lifestyle would be the same, because it's basically acting as something that you could use for your daily living expenses, and also for the family. So the family doesn't need to suffer. The person's lifestyle is also the same, because you have the lump sum from critical illness. So it's ideal to take both, and to take adequate amount of coverage.
Thank you. And another insurance question relating to health insurance. Should, for example, expatriates living in Singapore use MediShield or a private plan for their medical insurance?
For medical insurance, if you're an expat, it depends. If the expat is a PR already, then yes, you can use MediShield Life partly. But if you want to buy the rider, which would basically cover the deductible and co-insurance, this is a little bit technical, but the point is, yes, if you're a PR in Singapore or Singaporean, then yes, you can use your MediShield Life. Then you top up with the rider. But if you're an expat that is on a pass, whether it's a PP or EP or dependent pass, you don't have the option of MediShield Life. So you just have to take a private health insurance. That could be a local shield plan, which is a little bit more affordable, or the international health plans, which can cover you anywhere in the world mostly, and then have even more additional stuff that you can add on, like dental. But of course, the international health plans usually are a bit more pricey than the local shield plans.
Thank you. Well, I think that's all the questions. So thank you all very much once again for the presentations, for sharing your expertise, and thank you to our audience for joining us. Raina, Gary, and Joe are available to answer further questions. If you'd like to follow up, either find them on LinkedIn or via the website, linkwealthadvisers.com, or the email address once again is contact us at linkwealthadvisers.com.